And good morning or good afternoon to everybody, depending on where you're watching this from. My name is Marc Taverner. I'm the Executive Director of INATBA. INATBA is the International Association of Trusted Blockchain Applications. We are a trade association that represents the blockchain industry, and we work at the intersection of public and private engagements. We are very proud, as well as Pavel's organization, to have 170 companies as members of INATBA from over 34 countries. And they join our efforts together with 25 governments from around the world and over 45 leading academics, all experienced in blockchain, to bring together thoughts on 14 different work groups in verticals from finance through to healthcare, through to climate action, together with some horizontal focus areas on topics such as standardization, governance, and of course, interoperability. So the topics I would like to look at today are the intersection of anti-money laundering and blockchain technologies. And in a brief 15 minutes, I want to walk you through some very personal views. So these are not all the views of INATBA or her members, but some remarks from my perspective. I've been involved in the blockchain industry since 2014, when I started working with one of the original Bitcoin mining companies, a company called the Bitfury Group. So I've been involved in mining at a large scale, predominantly of Bitcoin, but then the build out of the technology innovation that saw us as the Bitfury Group get into areas that you would not have imagined, such as data center, energy, chip design, and then eventually the application of blockchain technologies for government use, most famously with land registry in the Republic of Georgia. So I've had some experience of seeing this industry grow. And the analogy I would like to start with is one where before joining Bitfury, I was doing a lot of work in a conference call business. And this conference call business had a very small niche. We serviced the very important conference call announcements of big banks. So typically their quarterly announcements and the internal discussions where the senior management discussed the relevant bonuses that would be handing out to the senior managers. So very sensitive content. And I will not mention the name of the bank, but a very large UK-based bank used to invite me to sit next to their chairman on the 37th floor when these calls were happening. Because as he said to me, Mark, I'm right-handed, and if something goes wrong, I need to have you within striking distance. So we were on the inside, we were trusted with a huge amount of very sensitive information, and me personally sat through these meetings. When I got involved with Bitfury, I contacted this bank and said, we should have a conversation because this represents innovation. I know you're interested in innovation because I've sat in all of the internal discussions that many organizations don't even know take place within your bank. And the response to me was, Mark, we like you a lot, but we're going to have to meet in the coffee store underneath the building because now you're involved in Bitcoin. Even if you sign the visitor's book, you represent a reputational risk for us. Fast forward 5 years, the very same bank was begging us to go and do learning sessions for their senior executives about this technology. So I use that analogy by means of introduction to tell you that there are different lenses, there are different ways through which you can look at this technology. And these are some of the ways in which I would like to present to you my thoughts on the intersection of anti-money laundering and blockchain. The first lens I would suggest we could look at this particular topic through is the regulatory lens. So many of you, in fact, all of you, are far more specialist in AML and KYC than me. I'm a technology practitioner. But my regards in terms of regulation are that we are dangerously using antiquated, very old approaches to regulation and regulations themselves to try and create structures to govern an industry and a technology which is advancing so quickly that even regulations that are being dreamt of today might perhaps not be a best fit. And some of the examples I would like to use as we look at the first tranche of how the intersection of AML and blockchain could be considered is just to refer back to the US. And as we know, the US has a very strong approach towards AML in the financial markets. And in fact, going back to the Bank Secrecy Act from 1970 and the third title of the Patriot Act from 2001, we see the very foundations of some of the most relevant approaches to anti-money laundering. And as we fast forward to the current day, some of the institutions such as FinCEN and most recently FATF are still building their approaches on some of these acts, some of these vehicles that stretch back to 1970. So if you look at the intersection of regulation and blockchain technologies through the regulatory lens, the first observation I would like to give you is that there is somewhat a risk, to use a phrase from your industry, that the vehicles that are being used and being considered might not be fit for purpose because they're coming from so far in the history that they fail to adequately observe the potential and the future direction of travel of this technology. I'd like to go a little further on this topic and just give you a few examples of my own observations. At the moment, FATF, with their approach, which I think the consultation is closing today on, so I can't go into too much detail as INATBA's members are contributing to that, and I don't want to leak our report before we submit it to FATF. But we note that certain aspects of FATF's recommendations are at best perhaps ill-considered. They are looking at ways in which you can approach setting a financial limit, whether it be $10,000 or whether it be $1,000 on the transaction level at which all information needs to be gathered by market participants. Now, on the face of it, this is quite interesting, and some of you might agree that this would be a sensible approach to take. But I put it to you that this has a number of implications, not least of which is the efficacy and the efficiency of those operators to comply with the suggestions, with the recommendations being made by FATF. And we do know that a number of industry players have got together to look at messaging standards and how they could work together to meet this requirement by establishing common protocols, common messaging standards, and common taxonomies so that the sharing of information becomes a little easier between parties to reach compliance with these recommendations. But notwithstanding, this is really using a sledgehammer to crack a walnut, using an English phrase. We believe it's slightly overbearing, perhaps maybe even impractical, and risks slowing the pace of growth. And furthermore, some of the recommendations coming out from FATF, and indeed driven, I think, largely by the approach in the US towards establishing a common KYC database of information on users, is something which presents potentially very high risks for privacy to individuals and very high risks for security considerations, not just from a technological perspective, but also from a human perspective, if indeed these proposed vast databases of personal information were to be technically hacked or socially engineered in hacks targeted at individuals. To turn to Europe, something a little closer to home, we see the European Commission has taken what we think at INATBA is a very sensible approach towards an attempt to harmonize the treatment of crypto assets and crypto asset service providers across Europe with a proposed piece of regulation called the Market in Crypto Assets. And what this proposed regulation intends to do is to harmonize the approach across all 29 countries in the European Economic Activity Area. And that takes the approach from a regulatory perspective based on classification of assets and classification of service providers, which then delivers a framework and suggests a set of rules that these operators and that these particular crypto assets would need to work towards. And that feels as though it's a more acceptable and more well thought through approach. However, when we look at the approach towards AML and KYC at the intersection of blockchain, I would like to suggest that even this approach is slightly antiquated. If we use the example of the marketing crypto assets proposed regulation, which took almost 1 year to create, was passed from the European Commission to Parliament for review on the 26th of September last year, it completely misses out reference to decentralized finance and doesn't even acknowledge the existence of non-fungible tokens. Both of these pieces of innovation have accelerated massively within just a period of 12 months, and I would put forward render almost obsolete this very well thought through proposed piece of regulation. So as we look at things from a regulatory perspective, I would advocate that the model perhaps needs to change and the focus more towards knowing your transaction, leveraging the power of the technology to focus on how the technology can help regulators place themselves at the center of activities, maybe by exploiting the protocols themselves and the very consensus mechanisms that put regulation at the heart, at the center of these business processes, and maybe even by so doing, allow them to put the brakes on activities before they happen, as opposed to always chasing activities after they happen and trying to find the legal entity that they can pursue. Because even in very well-established markets, such as those that large operators like Credit Suisse are accustomed to operate in, I think the very example that happened at the end of March with Archegos is, I think, testament to the fact that always trying to chase events after they've happened doesn't really serve the market very well. So that's the regulatory lens. To look at the technology lens, this is tremendously fascinating because the technology of blockchain allows for obfuscation. Now, I often hear from my past that Bitcoin and other cryptocurrencies are perfect tools for money laundering because they're completely anonymous. Well, I'm sad to say that they're not. And Bitcoin is amongst the least anonymous transaction tools that I've ever come across. So just a little advice, personal advice from Mark to all of those listening. If you don't want your grandmother, your mother, or your children to know that you've bought a very, very big and surprising present for them ahead of their birthday, don't buy it using Bitcoin because they will know. Buy it using cash because they will never know. And these technologies are misunderstood by many parties, largely due to the clickbait approach that has been happening in the media because it makes interesting stories. But through conversations with law enforcement agencies some 5 or 6 years ago, in a private conversation, a particular law enforcement agency in the US told me that they would be delighted if the entire world used Bitcoin to transact with, because that would give them the ability to trace every illegal actor, every bad actor that they ever wanted, with evidence that would allow them to enforce law in their country. So I put it to you that there is a little bit of a misunderstanding from a technology perspective. Now, that doesn't mean that there are technologies that can allow bad actors to obfuscate, to hide their activities, because there are. There are techniques that can be used, so you can disaggregate a transaction. You can break it up into a very small number of transactions and send those transactions through different exchanges around the world and manually then regroup those funds into a central place if you so wish to do so. And that might be relatively effective in terms of hiding the trail of that transaction, and therefore sidestepping the attempts of the authorities to impose anti-money laundering practices. And there are also automated tools called tumblers and mixers that allow you to run the same type of process, but in an automated fashion that might be slightly more effective than you running that individually or manually as a person. And all of these represent risks. Of course they do. But I would advocate that those risks are tantamount to the same risks as the traditional banking system, where it is entirely possible to gain access to a huge volume of cash, to put that huge volume of cash in a vacuum sealed bag, and then to measure it by weight to support transactions that you don't want to have anybody track. So wherever there are payment methods, wherever there are payment rails, wherever there are banking systems, there will always be opportunities for the technology to be exploited. And indeed, the final topic I would like, or the final example I would like to reference from a technological perspective, is that there are certain coins, there are certain cryptocurrencies out there, such as Monero and others, that do support privacy. And because they support privacy and allow individuals to maintain their privacy, clearly that renders them harder to get insight, to get information about who the ultimate beneficiary is and what is happening to those transactions. So from a technological perspective, blockchain represents risk, of course it does, but similar risks to the existing systems. And the one final note I would like to end with is that as we consider discussions around central bank digital currencies, the digital euro, the digital yuan, and various other innovations at a central bank level, the topic of privacy of an individual is raised enormously. And imagine a situation where the technology of money, whether it's cryptocurrency or a regular currency in China, is put onto electronic rails exclusively, allowing the government to observe every transaction that you as an individual ever make. We do believe within the blockchain industry that the application of central bank digital currencies using regular databases without the privacy that blockchain techniques and blockchain technologies can provide represents a privacy risk for individuals around the world. And so from an AML perspective, whilst knowing everything about everyone all of the time might appear to be the euphoric moments that we're all hoping for, the reality from an individual perspective is that it makes the citizen feel as though the state has now an opportunity to not only understand everything that they are undertaking as transactions, but to exercise a level of control that might be uncomfortable for many. Switching just to a couple of final observations. From a geographical perspective, as we look at the enforcement of regulations which are slowly coming to bear, we do think, I do think that there is a little bit of a risk for arbitrage to occur. And we've seen this happen before in the blockchain industry, where certain regulations are developed that provide legal certainty for this industry, meaning that a vast number of industry actors suddenly descend on that particular geography to seek the legal certainty of operation that they've been looking for. So that was one trend that we saw perhaps 3 or 4 years ago emerging. But now as we see recommendations such as those coming out of FATF, and indeed other forms of legislation as opposed to regulation occur, it leads to the opportunity for the different implementation of said proposals. And these proposals, such as FATF's recommendations and such as pieces of legislation inside of the European Commission and the Eurozone, whilst well intended, still leave some room for national interpretation and national execution. And that creates an opportunity for arbitrage. It creates an opportunity for certain geographies to try and create competitive advantage for this young and innovative industry, to attract talent, to attract innovation for their own benefit. And in so doing, provides less than a level playing field. So from a geographical perspective, I view that there is a certain amount of risk within the AML model as it applies to blockchain, in that arbitrage can still very much be a reality. And that creates uncertainty where the implementation of regulations or of recommendations, sorry, as opposed to regulations, could open up arbitrage, which makes the consistent approach or application of AML techniques less than visible, less than clear at a global level. And the final lens I would invite you to look at the intersection of AML and blockchain through is one of innovation, both technological and human innovation. Wherever there are rules, humans will always try and push the boundaries of them. We see this in established markets with the innovation at a product level, the innovation at a practice level, and the continued innovation even at a taxation level, with established market players whose role it is to uphold the market's integrity that they get so much benefit from. Even with these established players understanding that great systems such as AML and KYC provide benefit to them because it gives them market stability from which they derive their income, they butt up against the rules, the regulations, and the laws themselves in the continual seeking of competitive advantage. So from a technology innovation and from a human innovation perspective, we should anticipate that blockchain technologies will continue to be exploited to deliver these levels of innovation. And none of us should be surprised if, as soon as the best piece of AML regulation or legislation is introduced, understood, for the industry to follow, we shouldn't be surprised if the very next day we see an industry that is on target to reach $100 billion in valuation spring up just to exploit a loophole that they've identified. Because it is human nature, and within the realms of blockchain, we are seeing the deployment of technology innovation at a pace which I would put to you in my final and closing comment, none of us have ever had the pleasure of witnessing before. So finally, to close, I'm very envious of you all, because I think the topic of anti-money laundering and know your customer techniques, practices, and professions is probably at a point where it can have more positive impact on the world of blockchain than you could ever imagine. And I look forward to seeing what you do with this tremendous gift at this intersection of innovation and regulation. And rest assured, if any of you would like to benefit from INATBA and her members' experience, we stand ready to engage with you, to provide our evidence, and to open up our infrastructure so that you can engage in discussion. And with that, I thank you all for your attention. I'm mindful of the time. I was asked to talk for 20 minutes, and I fear I've gone just a little bit over. But I do hope that at least some of the crazy ramblings of this crazy British accented guy have been of gentle interest to you this morning. Pavel, back to you.
Mark, thank you very much. That's very insightful, and I think there's a lot of things that we need to follow up separately as we discuss. I think one of the very interesting note is that there are technologies already in crypto which are preventing certain transactions to happen if that high risk or clearly related to money laundering, which is in traditional finance it's impossible. So just to reiterate what you just said, so that's excellent. Thank you, Mark, and thank you for presenting and speaking to us. Well done. Thank you.
My pleasure. Thank you very much.